Welcome to a special Market Masters with Vetri Subramaniam, the Chief Investment Officer at UTI Mutual Fund. Well, lately the markets have had so many adverse news thrown at them. Low single-digit earnings growth in Q2, foreign fund exodus after the Trump win, a terrible GDP number that reinforces modest consumption and underwhelming capex growth. And yet, look at the Nifty, up 20% for the year. The small caps and mid caps are actually up between 25 and 33%, if I'm not mistaken. Of course, the Nifty has fallen about 8% from its September end highs. But does that make it more attractive? More importantly, how will 2025 pan out? For all these questions, like I told you, Vetri Subramanian, Chief Investment Officer at UTI AMC, is with us. Vetri, good morning. Thank you very much indeed for joining us. Let me start from my comfort zone. This GDP number, yes, it's lagged, but it gave us a little more bad news than I thought the Q2 earnings did. What did you take away?
Morning, Lata. Good to be here. Well, I'd say, as you pointed out, the GDP number is coming out with a lag compared to the high frequency data we were getting during the quarter. We'd already had some senses from companies during the quarter that, things were moving at a slow pace. One, because of extreme heat wave in some cases, then because of the monsoon, and few companies saying, look, the pickup that we expected post-election isn't really happening. So I think a lot of this was already baked in and known to the market because of corporate commentary. And therefore, the only market which reacted, more as a surprise to that GDP number was actually the bond market and the currency market. Because remember, that's the market and that's the market participant, which is the RBI stroke MPC, to whom the growth and inflation number is part of the policy making toolkit. And which is why you actually saw the bond market react dramatically to the collapse in, reported GDP growth, as well as the currency then start to weaken, given the fact that it sets the RBI on some sort of a liquidity enhancing, and the MPC as well at some point having to worry about the growth outcome of its policies.
Mm-hmm. So what are you expecting from the Reserve Bank day after tomorrow?
Very tough ask, Lata, because I think, the governor in particular, I think for more than a year and a half has been reiterating the fact that their target is actually 4%. And one should not just look at the band, but with inflation sitting at the top end of the band, I think it would be a very brave thought process for the MPC, though mind you, there are dissonant voices within the MPC to actually do a policy rate cut now in the current meeting. But, the OIS market is now a lot more comfortable with potential cuts in the rates over the next 2 or 3 policy meetings, and I would tend to go with that. But the RBI does have room to look and take a relook rather at its policy, both in terms of what it's having to intervene in the currency market and what's happening in terms of interbank liquidity. So I think I do expect some action from them to at least target an improvement in interbank liquidity in the short term.
Okay, no, but what is it for stock investors? Would you therefore want to buy banks, big banks, any bank?
Good question, Lata. Honestly, financials and the big banks in particular are something that we felt positive about. It's one of the few areas of the market where we think there is a very clear case for absolute, positive outperformance relative to the benchmark over the medium term. So that continues to be something that we are, quite positive about. I think, just to go back to that question that you asked earlier, I want to make one more point here, which is that it's not just the RBI's actions, and I'm talking RBI, I'm not talking MPC. It's not just the RBI's actions in terms of interbank liquidity, which are material. The RBI, in one sense, has been forcing down a slowdown in credit, maybe for all the right reasons, but this has been ongoing now for more than a year, both through their direct intervention by raising risk weights on certain categories on loan, taking company-specific actions in many cases, and essentially signaling to the market that it was unhappy with the growth of unsecured credit. Now, this might be for all the right reasons, but the fact is when you turn off that tap, it does have some impact on the economy in terms of credit availability and therefore demand growth.
Okay, well, one would argue that too much of money was going to people who perhaps would not repay at all, and so it had to be called. I mean, the MFI defaults, unsecured loan defaults, are telling you that story, so maybe it was not a bad thing. Okay, I'm more interested in what the stocks investors want to know. Let me come to 2025. Really, the reason why I called you. Does it look like we are going to be able to repeat this kind of? I mean, 20% is a good performance, even if it is 8% off highs. What does 2025 look like?
I think still a challenging time in terms of equity returns. I do think we've borrowed from, the future in terms of the returns that we've enjoyed over the last year, or for that matter, over the last 2 to 3 years. Because remember, equity market performance has been way ahead of earnings growth. So there's been a significant PE multiple expansion, and some of that amounts to bringing into the current or bringing into the past returns from the future. So my expectation is a lot more muted. Very quickly, Lata, we do run an internal model for asset allocation, which feeds into our asset allocation strategies. This model was at about 45% equity allocation. Think about the broad range as somewhere between 40 to 80% equity allocation. So it was pretty much at the lower end. Into the sell-off, it's moved up from 45 to about 52%. But in some senses, it's still below even the halfway mark relative to equity allocation. And that tells you all you need to know in terms of, our view in terms of the current tactical attractiveness of equities relative to bonds. We actually think the carry on bonds is still quite attractive relative to where the equities are, certainly with the 1 year horizon.
Okay, no, that's really telling. Okay, let me come to what you like within equities. You did say that you like the big banks anyway. Tell us about the other sectors. I mean, the ones that have done best in 2024 itself are the EMS companies, e-commerce, all the cutting edge. Would you still go after them?
I think honestly, Lata, outside of the banking and finance, it's a lot more stock specific at this point of time rather than sectoral. Simply because I think we are seeing a lot of mixed cross currents at this point of time. And really, therefore, what we would like to focus on is a little bit more of focus on picking stocks based on the fact that these are companies which have the cash flow and the ability to navigate through what could potentially be a slightly more protracted, challenging time, rather than focusing on narratives. But at a sectoral level, honestly, I must admit, outside of banking and finance, I don't have strong conviction at a sector level. Individual stocks and sectors and into this sell-off, certainly some of them have started to pop up, but I wouldn't really have a sector to throw at you. Just one final point I'll make. If you think about the market in terms of a spectrum between quality growth and value, the last 3 years, value has had a brilliant run. But I do think this is a point in time where the pendulum is shifting mildly in favor of quality growth, simply because I think too much of what's in the value bucket has seen valuations rise significantly. And secondly, too much of that is about narratives rather than actual outcomes.
Okay. I'll just move away from sectors for a minute. Would you think that we have to brave this FII outflow for some more time? Have you met people, investors? What's the sense you're getting? Yesterday's number was, fortunately, a small number. Should we believe it is petering out? The big FII sell-off we saw October, November.
I think there are two things feeding into the FPI sell-off, but again, this is very much a generalization because every FPI is different. They're not a homogeneous set of investors. But I think the two things that really stand out with most investors is that one, at a very asset allocation level, the yield that the US bonds are offering means that there is a flow into US bonds as compared to any other asset class. And that's pulling market money out of EMs back into the US. And the second one is that the US, which is now almost 2/3 of any global benchmark, is just very, very attractively placed, at least in the opinion of most asset allocators. And therefore, that's becoming the default market, which is sucking out money from everywhere else. Finally, when you look at India on a valuation context, and this is relevant when we talk a lot about investors who've had experience of investing in India over many, many years and over cycles, I think just the relative valuations of India relative to other emerging market opportunities, it is pretty much the priciest market along with the US market. Just means many of them are choosing to take a backseat. So it's the pull of US yields compared with the premium valuations for India, which is causing them to stand back. I don't think it is anything of a top-down macro negative call on India. I think most foreigners that we speak to, and we do market to a lot of them for the international monies that we manage, I think most of them understand the long-term structural case for India. They just want a better entry opportunity.
Fair point. Now, the guy who has stood out or braved this selling has been the domestic investor. How are you looking at this trend of superb retail investment entry? Is it a secular one, or is it that this guy has entered at a good time in the market, and if there are modest returns, as you point out, in 2025, this counter wind of retail investments may peter out, may plateau?
Lata, one of the interesting things that I'm experiencing over the last year in particular is how much of market conversations have shifted to the fact about flows. All my trading as an analyst in all these years, it was about picking stocks based on their fundamentals. And suddenly I find people only want to discuss flows as a means of understanding what will happen in equities. And I think that's completely the wrong perspective. It's wonderful that Indians are participating in equity markets. I've never experienced this in my career, so it's good that they are participating, but that does not become the source of a bull market. A bull market is based on how companies are doing, and we need to be cautious about valuations getting ahead of themselves, because that means you're eating into future returns. Secondly, we talk so much about demand, Lata, because that number is published every day. But if you care to do the hard work of looking at supply, just rough cut numbers that I looked at the end of October, there was about $54 billion of net buying by domestic institutional investors, including mutual funds. But look at the supply. IPOs, QIPs, FPOs, sell downs by PE, VC, promoters, 52.5 billion. And we're not counting everything because there are limitations to how well we can count supply. So my simple point is, it's great that there's demand, but for heaven's sake, also look at the supply. You can't just analyze the outcomes for markets based on flows. Healthy capital market for sure, but I think eventually equity markets are slaves to earnings, not to flows.
Oh, that's excellently put. Great lesson for not only 2025, but for all time. Thank you very much, Vetri. And I must say that we have saved our blushes. I started by asking you sectors and stocks and went into flows as a last resort. And to be fair, CNBC has done a goodish bit of work on the amount of equity sell downs and equity raisings that have happened today. Take your point entirely, and thank you very much for an enlightening conversation. Well, with that, we wrap up on Bazaar. Chartbusters coming.